Moving averages are without a doubt the most popular trading tools. Moving averages are great if you know how to use them, but most traders, however, make some fatal mistakes when it comes to trading with moving averages. In this article, I show you what you need to know when it comes to choosing the type and the length of the perfect moving average and the 3 ways how to use moving averages when making trading decisions. Step 1. What is the best moving average? EMA or SMA? At the beginning, all traders ask the same questions, whether they should use the EMA exponential moving average or the SMA simple, smooth moving average. The differences between the two are usually subtle, but the choice of the moving average can make a big impact on your trading. Here is what you need to know: there is really only one difference when it comes to EMA versus SMA and its speed. The EMA moves much faster and it changes its direction earlier than the SMA. The EMA gives more weight to the most recent price action, which means that when price changes direction, the EMA recognizes this sooner, while the SMA takes longer to turn when price turns. There is no better or worse when it comes to EMA versus SMA. The pros of the EMA are also its cons. Let me explain what this means. The EMA reacts faster when the price is changing direction, but this also means that the EMA is also more vulnerable when it comes to giving wrong signals too early. For example, when price retraces lower during a rally, the EMA will start turning down immediately and it can signal a change in the direction way too early. The SMA moves much slower and it can keep you in trades longer when there are short-lived price movements and erratic behavior. But, of course, this also means that the SMA gets you in trades later than the EMA.